Welcome back to the Money Focus Podcast. I'm your host, Moses the Mentor. And today we're going to be diving deep into the world of multifamily real estate with a seasoned expert, Bill Ham from Real Estate Raw. With a career spanning before 2008, so I'm talking about before the bubble, Bill has weathered every market cycle over the last 20 plus years, amassing a wealth of experience and a substantial real estate portfolio along the way. He's here to share his journey from starting with a duplex to teaching others the art of creative financing. So let's learn from a real estate maven on how to thrive across market cycles. Let's go. All right, Bill, appreciate you joining the show. Really appreciate you taking time out of your day to come and inform the audience about your real estate investment career and background. And the first thing I always like to start the show off with is for you to actually walk us through your career journey and ultimately how you started your business.
Yeah, absolutely. Thanks for having me on. Yeah, I started off in 2005. I was a corporate pilot by trade and walked away from aviation with a duplex. I don't recommend everybody do that, right? But I had saved up $10,000 and I had closed the duplex, my very first real estate deal. It was making about $300 a month. And I walked away from aviation, turned in my 2-week notice and said, I'm going to go figure out real estate. And for better or worse, I did. I was young. I was 28 at the time, no kids, no family, really no debt. So it was kind of an easier life choice for me. But that's how I went into real estate full time and flipped houses for a while and did wholesaling, did all the stuff that you do when you're getting started, and then slowly built my portfolio and moved up into multifamily over the years.
When I think of someone going into that career path, they have a passion for aviation and flying. So what made you want to pivot from that career? Just curious.
Yeah, well, I realized I probably wasn't going to be a very good employee. That's pretty much what it was.
Okay.
I decided I didn't like being told when to come to work, where to go to work, what to do when I got there, so not great employee material. No, really, I saw friends of mine that were out flipping houses, and the inspiration came from that. I thought, I'm the same as them. They're friends of mine. We were all hanging out at the same place last night. They got up and went and did some real estate deals, and I got up and went to work, and they made as much money as I made working all year in a transaction or two. And I thought, all right, something's wrong with this picture. And so I spent about a year just studying and learning and reading the books, all the books we started with, Rich Dad Poor Dad, all that stuff, right? And so just spent a while studying and then wound up closing my first deal. And that's how I ultimately made the transition into it, from aviation into real estate. Even though my first deal was a duplex and it was technically multifamily, I don't really consider my multifamily career to have started until a little later on. So I did a bunch of houses for several years. So I was in single family for a while.
So what were some of your initial challenges when you started full-time as a real estate investor?
Well, money, not having money was a big one, but I would say deals and money. And there's still the same issues that I think everyone faces throughout their entire real estate career. It's finding good deals. That's always the trick, right? And then being able to fund the deals, having enough people and net worth and network and all of that to actually take the deals down that you want to get taken down. When I realized I could do houses alone, and that was great, but the houses weren't really moving the financial needle for me fast enough. That's when I realized I got to get into multifamily. I got to get into something bigger, but I didn't have the money. I didn't have the net worth. I didn't have the experience. The lenders weren't very impressed with me at the time. So, I had to learn to become valuable to wealthy people and then get them to join me. And that's how I ultimately got into the business.
When you're talking about multifamily, are you talking about large, commercial properties?
In the end, yes. In the beginning, no. Okay. So when I first got started, my very first, as I consider beyond that, two unit, 9 unit was my first sort of what I would consider a real multifamily. So is that multifamily? Yes. Is it large multifamily? Not really. No. The second one was a 20 unit, and then I did a 27 unit. 44 unit after that. And then I started getting into some larger stuff, on down the road. But no, I did not go into big commercial stuff early on. Very few people do. Almost everyone starts off in single family, small multifamily, something like that, 2 units, 4 units. And then they kind of over time, build their portfolio.
many years in between, like the small multifamily 2 to 4 to the when you first start stomping with the
Actually,
big
like
dogs and
three.
the bigger deals?
Yeah, no, there is this for 3 years or so, probably good three years.
Years.
Yeah,
Okay.
3 years, 2 3 3 years. Yeah, I would say it's around that range. A
Yeah.
couple of years. Yep, building my team, building the credibility, being taken seriously, getting your brand, your name out there. All the things that we do in any business, really. And I tell people that multifamily is just a product. It's we still have to have the business understanding, and that's can be single family, multifamily, hotel, strip malls. It doesn't matter. Those are products. We have to have the business understanding of real estate to be successful.
And tell us a little bit about your team. So your company is Broadwell Property Group.
Correct.
So tell us about what exactly you guys do for the industry.
Well, Broadwell, I have two companies actually. I have Broadwell Property Group and BroadwellPropertyGroup.com, which is the real ownership and operation company. I also have an education platform, and that's realestateraw.com. So two completely different sides of my business. But yeah, the professional ownership side is Broadwell. That we own and operate apartment complexes and really have sold them all. So everything that we have, everything on that website, my portfolio, I've gotten rid of over the last year. Actually, probably need to update that website now that I'm thinking about that. Yeah, I sold everything off over the last year and a half or so, liquidated, got up to the peak of the market. I had some really good exits on some great properties. And that's where we're at now, sort of looking to get back in. So we're owner operators of multifamily. That's the short answer of what we do.
So you brought up a good point as far as, you had these properties and they sold them, right? So you hear different viewpoints. You hear people say, "Hey, I'm going to buy a home and I'm never going to sell it," or something like that. So kind of talk us through what why that exit strategy was important for you at that time to sell now. And it kind of leads into the market cycles and
Yeah.
some best practices maybe you can share with the audience.
Exactly. And so several things here. Buy low, sell high, right? And that's what we always do. And so my partner Tony, actually, who is Tony Morgan of Broadwell Property Group, I'll quote would say, you sell with a calculator, not a calendar. And I've always taken
Mm.
away from him that. And he's right. And so what we always do is we go in and we set our returns and we say we're going to enter the asset here. Our projected returns are this, and when we get here and we hit our objectives, we're gonna go through our exit, sell, and bring the investment home. So most of our deals and why we sell and why we exit are because they're syndicated deals, and so we have investors, we have partners that are in these deals, and that's the one of the main reasons why a lot of people have a misconception about owning real estate for long periods of time and legacy wealth. I teach and I lecture a lot around the country, and I talk about this a lot. We get into this concept of legacy wealth. And I ask people, who in the room wants, legacy wealth for their family? And about half the room will typically raise their hand on the legacy wealth concept. And then I say, okay, listen, is your concept to leave your family multifamily? And of course, everybody goes, yeah. And I say, all right, now stop and think about this. How do you know your family is interested in multifamily at all? You're learning
Sure.
multifamily. Do you know how many deals I've bought at an extreme discount from legacy wealth owners? You want a good deal, get on a probate court. That's where the deals are at, right? And so I tell people, you really probably are not doing what you think. You want to be leaving the legacy of information, education, maybe a business model, but an individual asset. We have to be careful about that concept for several reasons. They get old. That's the one thing nobody talks about. Oh, I'm gonna buy this apartment complex and own it forever, never, and give it to my grandkids. No, you're not. You're gonna make your grandkids slumlords. That property's going to be a pile of sawdust by the time they get it. Think about that. And then two, you have debt. Now, if you're buying the property all cash, that's a different story. If you have a loan, okay, the different type of lending in multifamily. And I won't go down the boring conversation here, but it's not a fully amortized loan. So you're not paying the whole thing off. They're ballooned. So one, you're going to have loans come due, and you're going to have to kind of exit every so often due to debt. Right. And then third, the main reason that you really don't want to hold things forever is market cycles. You have to have an understanding of how the market moves and in and out and up and down. And so you want to try and get in at the bottom if you can, or at least understand in a generality where we are in the market, and then position yourself. You don't always have to sell, but, you want to certainly position your debt and equity going forward. So those are the reasons I would say people tend not to hold on forever and ever. There are other ones, like partnerships break down, things like that. But those are the main reasons.
As far as past cycles that you've experienced, have you learned a particular lesson outside of what you just mentioned that you try to stay true to?
Yeah, there are three concepts that I always try and teach my students and tell people. It's what I call the three pillars of real estate: debt, exit strategy, market cycle. And in no particular order, right? But you have to understand all three concepts and get them working together to minimize risk. I'm not saying bring risk to zero. I'm not saying you're always going to be successful and always time everything. I'm not saying that. I'm saying that we minimize risk through understanding of number one, our exit strategy. That's the first part of our deal analysis. What are you going to do with this thing? You got to know the way out before you go in. Are you going to hold it and operate it? Or do you have a long-term loan, a short-term loan, fix and flip, BRRRR? There's all these different things we can do with this piece of real estate. Okay, next, what kind of market cycle are we in? Where are we at? Do we think we're going up in a market or down in a market? Where are interest rates, things of this nature? And then lastly, you have to say, okay, what am I going to, the loan that I'm going to get, does it fit the exit strategy and the market cycle? For example, if I'm going to go in and BRRRR model, buy, renovate, refinance, and I'm trying to do a quick turn on a property, I would not want to go get a 10-year Fannie Mae, fixed rate loan and all that, because that's going to come with a tremendous amount of prepayment penalty. So that would be the right piece of the right loan, wrong, exit strategy for that type of asset, right? Or for that type of exit strategy. So that's what I'm saying. You have to kind of figure those things out. And then what we're seeing in today's market, you have to watch the market cycles, because you don't want loans coming due in a down cycle if you can help it, right? And so when the appraisals are down, and I learned this after the '08 cycle, trying to do BRRRR back in the '08 cycle, I was buying things, renovating, and that was going great, and then we went through '08, and then my loan came due, and I went to that refinance part, and the values had fallen due to other people in the area going into foreclosure. So it kind of messed up that exit strategy a little bit.
You've grown your portfolio. You've been in the game now for some time. So I'm sure you've had to be very creative on how you actually finance deals.
Yeah.
And, I wanted to talk a little bit about that. So how do you leverage creative financing in your operation to ultimately grow your portfolio? What are some options that you've
Yeah.
used?
Okay. So creative financing is cyclical. It moves in cycle, right? So why are we talking about creative financing right now? Why weren't we talking about creative financing 3 years ago, 5 years ago, right? Because it's a problem-based concept. When sellers have problems, the market gets creative. If sellers do not have problems, if they can just go out, list the asset, sell it, get a higher price, all that, rising tide floats all boats scenario, then you're not likely to encounter creative financing, lease options, seller financing, things of that nature. But that's why we haven't seen this topic, and we are now seeing the topics because the interest rates have gone up and traditional financing is not working as well as it was. And so now for sellers to sort of get the price that they need, they're going to have to, start working with all of us on creative financing. So they'll answer your question directly. That's how I used it at the very beginning of my business after 2005 through not much through '08, but then after '08, tremendous amount of creative financing in there. And that's how I built my entire first portfolio, was all creative financing. So then we haven't seen it much over the last 5-6 years because market's been too hot. And then again, now we're starting to see it serious. So you're going to want to leverage this going forward. I am leveraging it right now. You're going to want to be looking for sellers that are motivated.
Motivated, yeah. It's so funny. Like you hear a lot of people say, "Oh, interest rates are so low," and I encounter different peers across the country that invest in real estate, and a lot of times they prefer when the market is more normalized, without these super low interest rates, because like you mentioned, sellers don't have to negotiate. It's like, oh, you don't want it, they don't have to do anything, they want to get top dollar. So it's better for an investor when the market is not as hot. What are your top tips for successful investing in multifamily real estate? What are some things you feel like every investor should know?
Yeah, I would say that you really want to build 3 systems. And if you can build your 3 major systems, then you've got everything pretty much locked down. It's deal flow, deal analysis, networking. And I cannot break the business down into 3 more basic concepts than that. Everything seems to fit under one of those 3. So if you're new, if you're getting into the business, whether it's single family, multifamily, whatever you're doing, you need to set up 3 systems. Deal flow. All right, deal flow is going to be a market selection. It's going to be working with realtors in your market. It's going to be going directly to owners. And you want to be analyzing about 3 deals a week, whatever it is you're trying to buy, from duplexes to 200 units, right? 3 deals a week. All right, analysis, deal analysis. You got to have a system for analyzing deals, because this is a competency times frequency model, right? We've got to have deal flow coming in the door. We got to know what we're looking at. So deal analysis, what's a good deal? Do you know how to look at a deal and simply, besides just raising the rent, besides just doing a renovation, right? I tell everybody, look for valuation through operation, not renovation. Do you know how to look at a profit and loss? Do you know how to see what a seller's doing, whether they're operating correctly? Is this the right price? All those things. So that's deal analysis. And then lastly, you have to have the network and the net worth. As we say, our net worth is our net worth. You have to have the team, the people, the relationships around you. That's with lenders, that's with investors, friends, family, the whole list, to be able to financially take those deals down, right? So that's what we're ultimately doing, and that's our 3-step system. So that's what I teach, and that's what everybody out there needs to be doing, especially if you're new to the business.
For new investors, do you recommend that they get a property manager or self-manage?
Well, interestingly enough, I recommend you manage, don't manage, and then manage again, basically in that order. So yeah, I think in the very, very beginning that it is good for you to go out and to manage a few units as you're building your portfolio. Smaller properties is really good for you. It gives you a great understanding of what it takes to manage real estate, helps you with a lot of understanding of what's going on in the business. But it can also be a huge opportunity cost. Property management is really nothing to do with real estate at all, other than the fact that it happens to manage real estate, right? It is a completely separate business. It has all of its own issues, its own problems, staffing, and all that. It's not free money. So that's where I say, unless you are really going lateral, unless you're really building your vertical, let's say you're really building out your business model, I would stop managing after maybe 10, 20 units, after you do it for a year or two. Get some experience, turn it over to a third-party management company, manage the manager until you build a portfolio of about 300-400 units or so in a particular market, city even. Once you have a couple of hundred units in an area, then you have economy of scale, and you can start hiring some bench talent then, right? Now you can bring on some people with skills, with a resume, and you put those people in place. Now you're bringing management in-house. So that's kind of an eclectic answer, I know, but that's where I say, manage for a little while for the experience, stop managing for a little while to avoid the opportunity cost, build your portfolio, come back, bring management in-house later on in your career. That's what I would recommend.
So for a growing investor, getting your hands dirty and understanding the operation,
Yes.
Focus on learning the ins and outs of what it takes to actually manage a property. And then ultimately to allow you to grow, you're going to have to offload that responsibility to get bigger deals.
Correct.
Because if you're worried about the day-to-day operation, you can't focus on the finding the deals, network, finding the money, because you mentioned hundreds of units, right? So I'm sure that's other people's money. So we need investors and things like that,
Yeah.
So if you're worried about coordinating a repair at a unit, that's taking you away from getting in front of people that can actually help propel your business. Correct. So it makes perfect sense.
I managed all the way through, and I realized in that middle period how it really slowed me down. And I looked at other people that were not managing, and they did not understand their portfolio as well as I did, and they did not understand operations as well as I did, but they also grew a portfolio faster than I did. So that's just been my takeaway from my own career.
My next question is around underwriting. So that kind of, that cost, how do you incorporate that into your deal analysis?
Yeah, absolutely. It's tremendously important. So when we talk about underwriting, it gets a little more complicated as you get more units, right? So when we're talking about houses, maybe 2 units, you're pretty much doing the 1% rule, 2%. You're saying, hey, does the rent equal 1 or 2% of whatever it is, the price? And then if you're saying, yes, it does, that's a good deal. We buy the deal. Multifamily is a little more complicated, not actually that much more complicated, but a little more. So when we get into cap rates and things like that, what I will tell you about underwriting in multifamily really starts with the lending. So I'm assuming, you're not paying all cash for real estate. I'm assuming you're going to go out at some point and get a mortgage and put some money down. Well, the underwriting then needs to be based on how the lender, bank, whomever, is going to underwrite that deal. So you have to have an understanding of debt service coverage ratio loans. And that's a different kind of lending than consumer lending, right? And we have debt ratio loans over here. You have to have net worth equal to or greater than the loan amount. So what we want to do now is to take some of these parameters, some of the things that the lender is definitely going to want to see. For example, a 1.25 debt service ratio, right? They're going to want to see that. So I'm going to use those lending parameters in my underwriting to backfill into a price and a value for the buyer, for the seller, excuse me. So as I'm looking at that deal and the seller wants $1 million, I'm going to go in and plug in their income, their expenses, today's mortgage. And I'm going to say, okay, does this deal cash flow? If I pay that price and I get a loan, am I putting down a normal amount, or is my down payment 40 or 50% down? Does it cash flow? All these different things. So that's underwriting. And if you don't do that, then you're at best gambling, and you really don't want to do that, right? So the risk is mitigated in the underwriting.
We can talk forever about commercial and its differences, but it's definitely from what I understand about it, it's more of a business, because that net operating income is what drives the value, as opposed to, what's selling down the street.
Yeah.
You and I can have completely different NOIs, net operating incomes, and we be two doors down. So that's definitely a
Absolutely.
big
You're
deal.
right. Yeah, I always
Yeah.
tell everybody multifamily is a complete split between asset and business. One side is the numbers, the operations, that is the business. The other side is the sticks, the bricks, the mud. There is a physical asset you have to go analyze. So we have two types, the financial business analysis and the physical, both separate.
When did it kick in that you wanted to actually, teach people about real estate? Or was that always the goal out the gate? Like, hey, I'm going to become an expert and teach, or did something flip off?
No, it was not the goal out of the gate. I signed up for an individual and I joined their coaching program, and I was a coach, and I became successful, and I closed about 181 units. I think it was my first couple years as a student of this one particular program. And so they circled back around and said, hey, we're looking for people to become coaches. Are you interested? And I thought, yeah, why not? It would, in the very beginning, I thought, okay, it's a good way to network. And that's what it's going to be for me, is becoming a coach and teaching. I'm going to get out and be able to raise money better. I'll be networking. I'll meet more individuals. And whereas that was true, I actually realized I enjoyed teaching and I enjoyed coaching. And so ever since then, it's just something I've done in the background. It's something that I've done, times like now. I've liquidated the portfolio and I've sold, and I'm looking to get back into the next year, 2024, 2025. We're going to be back buying. So right now I'm focused a little more on teaching, writing a lot of articles, doing podcasts, because I have a lot more free time on my hands at the moment. But it's always something I've done in the background, but yeah, I enjoy it.
I mean, that's a great problem to have, to be able to say, hey, take my gains when I can, and then I can shift to another passion. So that's cool. So kudos to you for that. So how do you cater your program to the individual?
Yeah.
What are some of the needs that you address for your students?
Yeah, what I'm going to do is I'm going to sit down, because I've been doing this for 20 years and I've been teaching for over 12 now. I have a system that I take the student through. So I'm going to sit down and I'm going to figure out several things, strengths and weaknesses, right? What are we working with? What do you have? What's the market you're in? What sort of, things we have going for us? What sort of relationships do you have? So I'm going to help you sit down and kind of go through all of this. We're going to work out a map, figure out what strengths and weaknesses you have, what things you're working with, and then we're going to set up a plan for figuring out the right location and the right size asset for you, the individual. So it is not a one size fits all. And then once I've got you figuring out, okay, what are you trying to buy? Where are you trying to buy it? We're then going to move into the how are you going to pay for it? And so that's those three systems. And that's what I'm going to build out for the individual. System on deal flow that fits you, system for deal analysis of whatever we're trying to look at. And then ultimately, how do we get you closing and get you out there, networking and working with individuals that help you go to the next level. So that's what I do. And I take my 20 years of experience and my proven systems I have education, I have the homework and the tests, and I got all that stuff because I've been doing this for so long. So that's how I do it. And I've heard every question out of the sun and had just about every problem a student can have, and myself, and worked with 1,000. I've had over 800 students so far, so almost 1,000 students.
You bring up a good point about based off the needs of that student, they may need to invest in an area that's not where they actually physically live. Is that the case?
Possible. Yeah, that is absolutely
Possible, yeah.
possible. Yeah. Yep. When I first started with a student, I asked them two very quick questions, two things. The first time I talked to somebody, where do you live? What are you doing for a living? And what I'm asking are those questions right there. So I was getting another student. I'm asking, what is your multifamily backyard? It's like when you walk out your house, what are we looking at? Is it a good market, a tough market? And then what do you do for a living? What I'm asking there is how flexible are you? Because I know the individual, wherever you're starting from, you're going to have to travel outward to your area and meet realtors and build relationships and analyze deals and walk properties. And so, yeah, now you've got to take into the real factor of travel time, life, family. And so we get into all this on those calls. And that's when I say strengths and weaknesses, I mean down to that level of tell me about your life, tell me what you're doing. We've got to pick a market that you can physically get to, because if you can't show up, you're wasting your time. Right. And so, yeah, those are all things that I really custom fit each individual.
What's next? So now that you have this time, you sold your property. So hopefully, 2024, 25 is a big year. So what's next? What's on the horizon for real estate
Um,
growth?
yeah, I'm working. I have two books, Real Estate Raw and Creative Cash, both on Amazon. I'm working on a third book now. It's going to be sort of more for the limited partner individuals. So I'm working on another book. We're networking like crazy right now. I see cash purchases with refinances in the future coming up. So that's what I'm doing right now is really education and doing a lot of that, but at the same time, heavy networking. I think 2024 and 2025 are going to be tough on debt. I think lenders are going to be tight. I think they're not going to be lending as much, even if the interest rates come down, that a lot of the lenders in their balance sheets are still going to be distressed for a little while. So that we're not going to have a
Yeah.
lot of lending let up for the next 2 years. And so creative financing and cash are really going to move the market going forward. So I'm doing both, looking for deals that I can use creative financing on, but also working behind the scenes, getting more partners, equity team members together, things like that. So what I want to do is to be able to go in and pick up some of these distressed assets that we're about to see and then refinance them in 2 or 3 years, 2 years when the rates are a little better. So that's the short-term business model.
In my area, what you're familiar with Atlanta, I'm seeing these homes, like brand new construction homes, and they're actually building them to rent them. And I just don't know how
Okay.
sustainable that is long term.
Well, so build for rent is
Mhm.
different than just a portfolio of single family houses. If you said, here is a build for rent property, here's 20 houses, 30 houses on one piece of land being operated as a multifamily property, they just happen to be houses instead of apartments. Yes, now that I'm very interested in. Yeah, that's a great model, but not so much on the let's go buy 50 houses all around,
All over the
DeKalb
place.
and Fulton County. Not doing that. Build for rent's what you're talking
Yeah.
about, and is it sustainable?
We'll see. My biggest concern is just how much rent they have to charge, for these
A fair
homes. I
amount.
mean, that's
A fair
scary,
amount. Yeah,
Uh,
what the ones that I've seen that were really successful have a lot to do with school districts and the neighborhoods and things like that. Yeah, because you're building a very high rental base unit. I mean, and again, if you're not familiar with build for rent, it's someone going in and buying a tract of land, maybe 5, 10, 20 acres, whatever, and putting a whole bunch of houses on it and renting out all the houses like an apartment complex, right? You have a pool and a community center and an office, but it's houses.
yeah. Well, we'll keep our eyes on it,
Yeah,
and
yeah,
if it materializes, great. I mean, more and more
sure.
people are, turning into lifetime renters at this point. So maybe it does work.
Correct.
So nobody wants
Yeah,
to own anything.
that's right.
So, let's close this out. What final thoughts or piece of advice would you like to give to the audience about real estate investing? And then also, let the audience know how they can contact you
Sure.
again, your website, social
Absolutely.
media. Just really appreciate you, man. Thank you.
Yeah, not a problem at all. Yeah, what I would tell people right now is pretty much ignore most everything that I've told you on this podcast. And just get started. No, I'm just kidding. But don't overthink it, right? Don't listen to too much of this, market cycle and the world's doing this, the world's doing that. That's all well and good. Just get started. It's always the right time to buy real estate. It's not always the right time to sell it. It's not always the right time to refinance it, but it is always the right time to buy a good deal. So you need to understand what a good deal is. That good deal can change. Its definition can change depending on the market, but a good deal is always a good deal. So yes, it's always time to get started, and don't overthink the situation. Just get out there, find somebody to help you out, and get going. That's what I would recommend everybody do. Reaching out to me. Again, I have two books, The Creative Cash and Real Estate Raw, both on Amazon. And my website is realestateraw.com. So if anybody wants more information about working with me, I have an education program. I will take you through everything you need to know to get started in the business, realestateraw.com. And Bill Ham Real Estate on Facebook. I have a Facebook group as well. But that's pretty much it. Yeah, realestateraw.com. Just hit that. If anybody needs anything from me, it's bill@gobroadwell.com. That's my email. Bill@gobroadwell, BROADWELL, gobroadwell.com. Reach out and be happy to talk to you.
Bill, I'll include everything in the show notes. So anyone who's listening or watching, just check the description. You can definitely tap into Bill. And you gave fantastic information. I really appreciate you joining the show.
Thanks,
And we're out. Bill, your journey and insights are incredibly inspiring, offering a blueprint for success in this ever-changing real estate market. So thank you for sharing your knowledge and experience with us. And listeners, make sure you reach out to Bill for his strategies and also to possibly transform your real estate journey. So visit realestateraw.com. And for more enriching discussions, don't forget to hit up my website, mosesthementor.com, and also subscribe to Moses the Mentor on YouTube. So here's to building your real estate empire, one investment at a time. And until next time, peace.